back, everyone. Good to be back. Dogs have been walked. Coffee's been made and poured and drunk. Some of it. More to go on the coffee's front. Coffee's a good trade, interesting trade this year. I think we ended up making some money on the upside at one point last year, maybe. But this recent coffee trade is pretty interesting. I trade three coffees: the U.S., UK, and South Africa or Brazil. I can't remember which country. And I'm short two of them and long the UK. So that's one of those good trades. Kind of fun to trade 350 markets and then triple up on the coffee. And then it makes perfect sense why you triple up on the coffee, because they're called different things. They are different things. And then my cocoa is getting hammered. I was wanted to blame that on vol management, vol targeting, all the CTAs trying to get out, but not sure about that. And UK is hanging in there a bit better, quite a bit better than the US. And I think live cattle is doing a little bit better than feeder cattle. So it's pretty fun to trade all these markets. And then it's been an interesting week on the trading side, on the Twitter side, of course, over the weekend. Little chaos explosions. Some of my friends not enjoying my comments. Our session last Friday struck a nerve. The markets have been crazy with the bonds going down and the stocks going down, and crude hitting all unleaded. What a disaster! I've not seen anything like that. It's quite a sell-off in those markets. So yeah, I'm not sure. I don't even remember seeing any fundamentals as to why this is occurring. Some sort of explanation. I don't pay attention to them, but I kind of like them just to see what's going on. A lot of good things to talk about today with the 60/40. Just popped up doing short trades. I have a lot to say about both of those. Oleg,
Uh,
you're a speaker.
Hi Jerry, hi Richard, hi Bruno, hi Alp, hi Cardora, hi Jerry Smith, The Bone, Marcel, Abizan, Josh. I'm very glad to see you all every week. Oh, I'm still in the wild nature. I'm still living in tent in the wild nature. Soon will go. I'm going soon to my home city, to Novorossiysk, maybe when it will get colder. So, very happy to be here as always. And I see that is dangerous scout meeting. Foreign trading, I don't just dangerous scout meeting. Yes, our scout is maybe dangerous. Yes, I like this idea. We're thinking a lot, of course, about the markets, as I always do. And I was thinking all week maybe that about the words of Maritz when he said in the podcast Algorithmic Advantages of Richard Brennan. He said that it's very easy to find a complex solution that we will work for maybe that will work maybe for year one, two. It's not the exact words of Maritz, but he means that. But it's very, very big. It's very difficult to find a simple solution that will be working for decades. And it's really an issue. And our methodology solves this issue, in fact. So we have a simple solution that, as we can see, working at least for decades because we have pawns it works. There is phone just a big capital is working for 40 years. Down capital is working 50 years, and we see this. It's a very big evidence that our training system, our trend following system is really perfect, and it's not the only evidence of the perfectness of our approach. It's not the only evidence, and I have said many times that of course, our philosophy, our logic, our math approach, and many other things. So, when I'm here, I'm always really happy. And let's get started. Our transforming trading ideologies. And I'm sure that the discussion will be interesting to all, very, very interesting to all participants. I'm very sure that it will be very interesting to all participants because every day I'm thinking about our discussion. Every day I'm thinking about it and I'm waiting for it. So it can't be not interesting to anybody. But let's start it.
Wow, that's quite a. I left my mic unmuted so you could hear me giggling at your dogs. That's pretty funny.
Or were
I
they
have like five.
Timberwolves?
That's
Oh,
right.
I'm sorry. I'm sorry. This dog. It's I'm in the forest, and this dog is hunting on a bird. It's hunting on a bird. That is the sea, and this dog now in the sea, and it's bow in the sea, and this bird is not available for this dog. The problem it's not available for the dog, so it's not my dog. It's a dog in the forest. So, and this dog has idea that this dog wants to capture the bird, but it's not.
I mean, who wishes they were Oleg right now? You know, I mean, how much fun would that be? He does come out of the cage. Both of those guys come out of the cage. The dog and Oleg come out of the cage very strong in the morning when we start our. Another thing I wanted to mention too was this unbelievable, incredible performance from Mulvaney. I mean, this is like off the charts. And so, I'm a big Mulvaney fan. Uh, there is a lot of evidence that he's a pretty secretive guy, really smart. Totally admire him. And there's a bit of evidence that he is quite the classic trend follower. Although there is a little, Richard has pointed out recently and prior that it's a little bit of some of the presentations. There might be a little bit of a hint of doing things in a way that we would not consider to be classic trend following. But man, I got nothing to say. I'm just pointing it out. He's amazing, marvelous, and he was called by my friend Michael the top trend follower, and I'd say that's like an understatement. Quite the top trend follower here recently. But wait a second, this performance is getting a little out of hand. Where now I'm crossing into extreme jealousy. Not happy with Mulvaney. It's just performance is too good. It's too out there. It's we all one of the great things about trend following is we share, and it's one entry, one exit, and a stop loss. Trade a lot of markets, go short, trade the four different sectors and crypto if you want, and trend follow and loose pants. And hey, we all end up with reasonably good similar performance, over time. But this guy is putting too much distance between himself and us. He's like the Michael Jordan, and the second best basketball player in the country is not that happy. He's being second is like not that close to being first. So I don't know what to say about this guy. He is just too good. And he did do a podcast within the past year or so with Niels, which you should, no, with Covell. You should definitely go out there and grab it and listen to it, especially on YouTube, where you get a transcript because it's bad audio and it is his accent. So if you're don't have an American accent, you probably understood it pretty well. But the world revolves around America and Americans, so that's the way life is. But now the trend following world is located. the center of the universe for trend following is wherever he is right now. He's that good. Okay, Richard, you want to take off and like to hear
G'day,
from you this
Jerry.
evening? G'day.
Yeah, look, I agree with Mulvaney. He's starting to make us look. It's getting embarrassing now with his performance. It's superb, and yeah. So I think there was a comment made by Bloomberg, a report on Mulvaney just recently, where they said he was non-committal in his willingness to share his black box. And as soon as I saw that black box, I thought, well, come on now, people do have access to his institutional presentations. So I shot that up on Twitter anyway. If anyone wants to access that, they've got to do a few clicks and they've got to sort of subscribe to that free provider. But it gives you his presentation. But yeah, interestingly, Jerry, there's a lot that we nod our heads with his approach, but he certainly is far less diversified than we are. I think he's got about 45 markets or whatever, but and there are a couple of explanations in his institutional presentation which just make me wonder if he is doing something slightly different. But, he certainly had a fantastic performance. But look, on that matter, congratulations to you, Jerry, for your significant rise in AUM for TFPN. That's a magnificent result you've got in a very short period of time. So a big congrats there. And look, I really love that podcast we did with the two Maritzes on Algorithmic Advantage. I hope everyone's had a chance to listen to it. I love these guys, and I really like Moritz Hayden as well. He's a lovely bloke, and I tell you what, he's got some good marbles in that head of his, and there was a lot of very sort of wise wisdom that he was sharing with us in that podcast. And the recent podcast we did with Mark Malik, that was interesting. Mark's clearly not a trend follower. He sort of sits more in the Alpha Quest camp of short-term momentum. He does have a few short-term trend following models that he mentions, but this algo advantage isn't focusing just on trend. It's a very wide gambit, so it gives people a chance to have a look at lots of different approaches in there. We're going to have some research providers coming on to the pod as well, so we're going very wide in the field. I think it's going to be very interesting. But Jerry, I'd like to hear your feedback regarding the scuttlebutt from last week's Twitter. I sort of had my head out of Twitter this week most of the time, but so did we get some people's noses out of joint?
Yeah, I mean, we lost Michael, and I was talking to him a lot after, and he kept saying he's a great guy, and I really like him. He's really smart, and he's my friend. And I told him before he blocked all of us that he was my friend. And but I think his response was he kept saying like, "Okay, I blocked everybody, and then I'm going to block you this afternoon." So it's like, okay, so he ended up blocking me, and then but he was like, "Yeah, we're kind of friends and everything," and but I think it's best we block each other, and I think he's right, because it's probably correct because we kind of get into it because he writes things that are provocative, and we just have to comment on them. And I think I don't really know. I can't control other people going over the line. I can't even control myself going over the line. And I guess I went over the line for him. And so, yeah, I mean, for sanity, there's no reason for us to go back and forth and critique each other and have these opinions. It's really because I'm more of like a lot of times I'll tell people who text or who direct message me or post things. I'm like, hey, get on Spaces and let's talk about it. I'm much better at talking about it and flushing it all out and not having to write it out because even writing, it's not as clear. And but he quit coming to our podcast. I mean, our Spaces, so we lost that avenue. But it was he has blocked me before, and because I would argue with his trend following, and that was years ago. Then somehow I kept enjoying his writing, and then we kind of became friends. We started following each other again. So it's just a matter of time. And I think he was more of the adult, realizing that we need to divorce, and sometimes that's the right solution. I will
Yeah,
say
fair enough.
though,
He blocked me as well, so maybe a good
yeah,
divorce is needed.
yeah, exactly. So we can have all kinds of disagreements, and if we lose, I don't like to. And contrary to what he was kind of saying, is that I told him this. I'm like, I love your writings. I love to discuss them. And it's just, I mean, I'm just not going to agree. I'm never going to agree with some things. But if I look up on the screen this morning and I'm missing a few of my friends, because I'd be very sad, even though we don't really agree on everything. But we still have fun, and we all kind of over time compromise and moderate our viewpoint as we listen to these other smart people talk. I mean, I'm not affected by good arguments. I'm very affected by them. So, but it was one thing that was very interesting about that back and forth with him is that I think Moritz brought this up to him, or definitely to me, is that I went back and I read the article that he said we misinterpreted and um, that we misinterpreted it, and we didn't read it carefully or whatever. And the fact of the matter is, we never talked about the article. I was thinking, like, how did I miss this? I read the article, and there was nothing in the article that I was very interesting to me, and I could, because I kind of agreed with everything, and we eventually got to that point with him where I said, "Oh, I agree um, that trading more markets does improve, like my Sharp, let's say, or theoretically should improve my Sharp." But I never said I did it because of that. It was a result of trading lots of markets and hunting outliers and pursuing outlier hunting and small bet size and smoothing out, distributing the outlier trades more evenly throughout the data. My
But
track
didn't Mike
record,
say that the best level of diversification was sort of 10 to 20 markets? Didn't he say that in that article?
he this is what I was going to say. So I couldn't understand how I got it so wrong, but then I remembered we were critiquing his comments about his own article. And he went much further in that article, in his comments, than was in the article. Jojo was commenting on them. I was commenting on them. Jojo was asking him some great questions, like 10 to, I agree with, he would say, I agree with Andrew and Gestalt, or return stacking people. Corey, I agree with them, 10 markets or 26 markets. And then Jojo was like, well, they do that for replication. They're not saying that's great for Jerry or for all trend followers, but it's enough and best for replication. So there was a lot of things where he just went beyond his article that we were all critiquing. And he missed that, I think, in that he said we missed the article. It wasn't the article I even paid any attention to. It was, yeah, the overstatements and the things that I can easily disagree with. That the compounding of trading more markets helps with the compounding. And as Moritz pointed out, and I pointed out a million times, when you trade more markets and you have more diversification, you can increase your risk budget a bit, and trade a bit larger. So these are like irrefutable, really. And so, anyways, it was good, and he's a good guy. Our paths will cross again, and we will talk about trend following again. And he's like, sometimes I'll read an article from him, and he's incredibly pro trend following. Then later, it's anti, or very skeptical of it. So that's. But he writes a lot of good stuff. He has a lot of people who like him, and I like him. So it's kind of unfortunate, but when you have these strong opinions and personalities clash, and it's fine. He was correct. We should not obsess over each other and just move on and enjoy writing their stuff too, and talking with people and tweeting with people who are more in agreement, not know what's going to be in complete agreement. So, oh well. I definitely apologize, but if we went too far, because I feel like we did by definition, if he was unhappy, but could all been. I'm not as sensitive. I get very sensitive on negative comments on my tweets and on me personally, but not so much if it's a discussion for some reason. But yeah, I silence people. And then I came up with that way, and I got tired of listening to him critique me, and it's like he would say, well, trading 300 markets, blah blah blah, and then I would comment, and he's going, I'm not talking about you. Oh, okay. I know this trend follower who trades 300 markets and 150 stocks, but I'm not talking about Jerry. So I got tired of that. So I started tweeting things and only allowing people to comment who I followed, and I stopped following him. So that was my little tactic. And then, of course, Elon has promised to get rid of blocking. Uh-oh, what's going to happen then? So I'm not
I
sure. I
hope
don't.
not.
I hope not. I hope not. I hope not. All right, let's talk about 60/40 and CTA stepping into that breach. And that would be nice. Although I would like to see the 60 piece replaced by the trend following of stocks. And there is no 60 long and buy and hold long only. I think the trend following can be a good replacement and a sufficient replacement. Maybe 10 or 20% long S&P all the time, but why
We're going to
are
need
we
absolute up here, Jerry. We're going to
yeah,
need
why
absolute. He started the whole ball game rolling.
I know. I know, and he started this other idea I want to talk about as well. Don't leave us absolute. We need you.
Hey guys, yeah, I'm here. Yeah, well, it was funny with all the dog barking and the wolves and the bears with the tent in the forest. It's so funny. Uh, so yeah, so I think I posted a couple of things maybe ahead of the spaces. The first one was it was this shockingly bad chart of this 100-year Austrian zero bond that I cannot imagine anybody. It's like I just commented also. I tweeted like whoever bought this thing like a few years ago when it came out or when it was trading like above par, above 100-year Austrian bond. So you're lending Austrian government money, and at the time, at some time, it was a negative yield. So you're lending the Austrian government money that it will return to you in 100 years, and it will return to you less than what it gave you gave it to you gave. So you give $100, and it's gonna give you $90 back 100 years from now. And some so-called quote unquote asset managers or whoever, somebody bought it, it's traded, it existed, and put it in a portfolio 60/40, whatever, a bank, a pension fund, or whatever. And I cannot imagine these people or traders or committees still living. I mean, still doing what they're doing, and they're not, instead of fishing or I don't know, paving pavements or something, or chopping wood. It's unbelievable. So this bond now is trading at 2, where it was trading at par, above par. Now it's trading at 2, so it's 98% down. So again, I've had this question before, and we've discussed it before, and we haven't made the. I mean, this is one of the things that one of the arguments about the difference between position sizing and keeping the size fixed. So my question to Jerry was, if you shorted this thing, whatever it broke down at 95 or whatever, and you wrote it all the way down to 2 with fixed size as you entered it at 95, would you still keep that big short position on when the upside is now only $2 when it hits 0, if it hits 0, and the downside is wherever the exit trailing stop is, which is probably much more than $2. It's probably 10 or $15 to stop you out. So at this point, a classical trend follower short would have a big short position with maximum upside of $2 and downside of 10 or $15. I don't know, wherever the stop is, the loose span stop is. And the question is, would you still hold this short, and why? Given that the basic philosophical argument in classical trend following is exactly the asymmetry of return versus risk. So we are philosophically committed to the asymmetry of keeping losses small and shooting for unlimited upside. which is what we're doing, hopefully. And that's where the outliers are. But currently, even though the trade is very profitable and it's great, so it came down from 95 to $2, a lot of money made. If you stick with the rules, now the asymmetry is gone. And this is typical, what would be typical of most shorts, because they have the absorbing barrier of zero. And as they approach zero, the more they approach zero, the closer they come to zero, the bigger the bigger the ratio of loss of risk to return, because the risk is now $15 away in terms of losing what you have now to the trailing stop, and the upside is only 2. It's not unlimited, far from unlimited. And the closer you get to zero, the worse this ratio becomes, and the further you go away from your philosophical committal to asymmetry. The asymmetry becomes completely reversed on its head. So my question is, what's more important, sticking to the rules as designed, or doing something to fix, or at least not spoil, the philosophical fundamentals of your approach, which is asymmetry of unlimited profits versus limited risks. So this is what I just wanted to discuss. It's more like a philosophical discussion.
Well, I think you laid it out really well and you hit on the topics. And I am on record as saying that this is one of the areas where I cheat, and I create rules. I create different rules and I follow them, but they don't. They pretty much align with what you're thinking. But I go back to the entry and I sort of say, on the short trade, is this going to be an outlier? And I do assume if it goes to zero, that's as low as it's going to go. And then, so when you run the back test, you'll see, oh, okay, price divided by ATR. If it's less than a certain number at the short entry, then it's going to be kind of a really, really subpar trade. And there's kind of a break even point. So I filter out those shorts um, to begin with. And then, of course, as it gets closer and closer to zero, I do get out. I get out at a certain point where I say, okay, just like you're saying, it's but it's sort of based upon the back test as well, and so it always tends to work. Of course, crude went negative. Half my markets are stocks, so they're not going to go negative, I don't think. And then you can flip it around, and you can do it on the interest rate side and assume that there's some, well, I was going to say complex. It's complex for me, but not for my research staff, to figure out, okay, what is the zero level of the future, or the bond future, and do that same formula, assuming it can't go to zero. But they did go to zero, and they even kind of went negative. And so I always thought that was a problem. And it definitely, in 18, my performance was very subpar compared to most everyone else. 2018, I think, and 18, 19. Anyways, around that area, the last big leg up in the bonds, I was on the sideline on those bonds. So I needed to adjust those rules and that thinking, at least on the upside. But and I've had tremendous failure with this sort of filtering out of short trades. And the last time was 2020, and it also happened in other periods, 2008 as well, where there was a lot of crappy short trades with very limited potential profit to the downside in both those periods. And I tremendously underperformed because they all went down. And so as a group, you were not ever going to make very much money per trade. And you know how I focus on trade stats and per trade everything. But they all had like little nice moves to the downside in this one quarter, and so in 2008 I had subpar performance, but then in the first quarter of '09, all those short trades reversed, and they became nothing trades or losing trades. And so I had overperformance the next quarter. And then the same thing happened at COVID, where I wasn't short because of that filtering out those bad shorts. They had a lot of them moved in unison together, and they made money. And I tremendously underperformed. I was beside myself when this happened. I was like, "What the hell?" And then, of course, they didn't go anywhere, and they reversed. And the next quarter, my performance was a bit better because I didn't take those losses, and there was no really material profits there. There never was, but it does help. Just like all the shorts are pretty crappy, and so they do help a lot during the bad periods for the longs, which I missed. And so there are other reasons to do the shorts initially, but then I would be even more hard pressed, like Absolute is saying, to stay with them when they got so low that there wasn't very much left to zero, and then they're going to rally from there. They're going to rally from something, and the trend follower. So you have to. Okay, but this sort of formulaic approach is like Absolute was hinting at. Um, it's not necessarily the way that vol managing people and managed futures people look at it, because I am always like not short. Like there was this big, huge monster downtrend over the past few years. Well, I don't know how many years ago, but it lasted years and years, and it's a short natural gas. And I would listen to traders talk, Winton and famous traders, blah, 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 short natural gas. And I'd go, crap, I'm still not short. And this trade made an wasted trade, barely going down, barely making any money. And yet, and I was thinking, like, why don't these guys not do that, But, like Absolute was saying, if you continue to, you don't really know at the entry that I'm going to keep my position constant. My ATR is constant. I'm in, and then I'm going to stay in until I get out on the upside breakout. So, but they don't do that. They keep, you could put that trade on it. It's pretty crappy at the first breakout. And then a month later, the ATR is so low, you can like double, triple your position. And so there is no like, okay, this is what I'm going to make on this trade. Like for me, that's what I say, and that's true. But for them, it's like, we don't know. The vol could get so low, we could have 10 times the position. Then it would be a much better trade. So they're not subject to this limitation that I am. So that is one of the differences. I'm not saying I'm still not going to do that, but it's just, admittedly, that is a situation where they don't have that. They don't look at it the same way. So that trade that's pretty crappy in my book, and will be until it becomes a long, it can definitely over time improve because of volatility lessening. And so it's just another way that I kind of cheat the system. And because I am more into this per trade stats and this asymmetry, and but it does have downside, and because you will have relatively poor performance, and not trading shorts is probably going to give you better overall, per trade performance, but it's not going to give you probably a higher CAGR, because those short trades in general are going to help smooth out performance and limit the drawdowns. And so I could see the argument for taking all the shorts as well without this sort of ATR filtering. But when we did the back test, it's definitely said don't take the shorts if they're really, really bad. What do you think?
Yeah. So this. So there are really two separate subjects that are obvious here. Two separate questions. One is your initial filter or determination whether to take a trade or not, depending on how many ATRs you have to zero. So if you don't have, you have probably a threshold where, I don't know. So if you're risking 6 ATRs and there's, only twice that of ATRs left to zero, or 3 times, maybe you have like 10 or 20 ATRs to zero, then you say, you know what, 3-to-1 is probably not a good ratio. I like to have more. So you probably have like a threshold filter where you say, if the price of this instrument is here, the ATR is here, I divide the price with the ATR and see how many ATRs the price has to zero. So you probably have a threshold here where you say, hey, if it's less than 20 ATRs, I'm not entering this short because the most I can make is 20 ATRs. So that's your first filter. And you filter.
And you won't make 20 unless
Yeah,
you
yeah,
get
of
out of
course.
the,
That's the
unless you
maximum.
get out
Yeah,
of the trade in
of
another
course.
non-trend following way. So it's
Yeah, yeah,
and
yeah.
and I just
Yeah.
based it on the back test. Honestly, that's what I did. So
Okay, but basically, so now when you do when you run a back test, you have a parameter and say when you test or probe a potential trade, you have a filter overlay where you say if this trade at this entry is less than 20 ATR from zero, I'm not entering. So that's a filter. I'm assuming if it's systematic. And I know you're not going to make 20, but in order to make it systematic and not discretionary, in order to run a backtest, you have to have this filter when you're running the backtest where you're eliminating all trades. You're not entering any trade which gives you maximum theoretical potential profit of less than 20 ATR. For the longs, there's no such limit because infinity is the limit. But for shorts, you probably have to have such limit so that the backtest can, in a systematic way, filter out these trades so that they don't happen. For the backtest to be consistent. Am I correct?
that's right.
Okay, good.
That's pretty simple, not controversial. But
Yeah, yeah.
there, it once again, people have said over the years, and I remember my closest trend following friends would say, you should go out there and find systems you can find systems that don't make any money at all. They're negative. But if they're different from trend following, add it in there, and that's going to help with your drawdowns and smoothing things out. And so I look at shorts that way. They're not really that great. They don't really measure up to this average trade, the expectation like the longs do, but we still do them. And so this, in some degree, taking these shorts at all, or definitely taking all the shorts, is sort of like your crappy system. It's the system you're willing to trade with the long trend following, and it's not going to do very much. So I'm not necessarily against. I've made the choice to add this filter, but it's totally. I can understand if you didn't want to add it. Go ahead.
Okay, I get it. So that's the first question and issue with the shorts, and then the second question was the original question as to, let's say you pass the filter and the short is good. So I don't know, you have 100 ATR of potential profit. So it's $100. ATR is $1. You're entering at 100. You have 100 ATRs to zero. Plenty of outlier potential. So you enter it at $100. Enter the short. And you make 98 ATRs, but now it's at 2. Now the problem is as you approach zero, what do you do? And is there anything that you can do in a systematic way that can be more consistent with your philosophical, with our philosophical commitment to positive return risk asymmetry? And as I said, so now as the short goes to zero, we are getting more and more into conflict with our philosophical commitment of positive risk return asymmetry
That's
because
right, and that's right, and that's confirmed. That's confirmed by the back test. So yeah, exactly. You could have a great short with 1,000 ATR potential profit, and then at some point in time, if it goes down too much, you're going to have to implement this second idea, which is, hey, it's down to one ATR left. I mean, how about one? You're going to get out at one if you're that lucky. Of course you are. I mean, and the back test is going to say, I tell you what, back it up a bit, get out before one. But this is all sort of curve fitted based upon the shorts of the past, and but it's still a situation where you kind of know that when there's limited amount to you can probably do better with some sort of theoretical mathematical formula, uh, but I think getting out quicker rather than waiting in some ways is whatever you do is probably going to improve performance. I mean, and so I do that, but it doesn't happen that often. This is a very rare thing. It's very common to get filtered out of the shorts. but it's very uncommon to get to these low levels where the back test says, hey, go ahead and kill this trade. As soon as it closes below this particular level with this many ATRs left, go ahead and kill it. I'm never that lucky. It doesn't happen very often.
Okay. So yeah, I mean, this is more like, as I said, this is philosophical. It probably doesn't have much utility in terms of actual performance improvement or whatever. It's more like, okay, but yeah, these things happen rarely because in the last 40, 50 years, we've had this 60-40 monster chart where everything is going up and the tide lifts all the boats. And of course, everybody's making more money on the long side than on the short side. It's much harder to short things. But what if the next 20 years look the opposite and where much more money will be made on the short side, on the long side? So then after 10 years of that happening, then people will be, reconsidering their assumptions about what works and what doesn't work and what affects performance or it doesn't. Then maybe having a approach consistent to your philosophy, which is positive reward to risk asymmetry, may put you ahead of the rest where it matters. So this is all I'm just thinking, and this is how it's a segue to go into the 60-40 chart, because we cannot anticipate and predict how the world will change when this monster 60-40 50-year bull market flips or stops going up the way it does. I mean, careers will be questioned, rules of thumb will be questioned, philosophies will be questioned, textbooks will be questioned and burned, books, rules of thumb will be burned. So the question remains, what is universally true? And what is or has been true only because the 60-40 has been in a ripping bull market the last 40 years? This is how I'm connecting these two things.
Well, I would say that, I think that you cheat the trend following and you use filters you better be careful, at your own risk. I'm doing things like this. And so you got to be pretty careful about it. And if it doesn't, I'm ready for it to blow up in my face a bit. Although I think this one is difficult to blow up in my face. But I remember this same person who knows more about trading than anybody I've ever met before. I remember telling him about this research we did. So we did this other piece of research where we came up with this idea of filtering shorts by looking at the futures markets, and it was pretty universal. Then I would talk to some other friends of mine, and they would say, "Oh yeah, I came up with this as well, and I use the exact same parameter, and I call it the same thing you call it." I'm like, "Wow, okay, cool." So and then other people did it differently. They would piece it in, and if it was such kind of a bad trade, they would do 90% of the trade. If it was really bad, they would do zero. So there's different ways of handling this. But then anyway, so we ended up running this same filter on stocks, and it didn't matter how strict we made the filter. The shorts on the stocks did not do very well, hardly at all. I mean, I was going to say they didn't make money, but probably. I mean, I don't remember exactly. They may have eked out like a little tad of money. And I remember telling this to my friend, and I said, yeah, the short stocks never make money. And we have cheated. We have tried every crazy idea that we wouldn't even implement because it was so curve fit. They still don't make money. And his response was, they will. One of these days they will. And then, of course, and so that's what you have to go by. You can look at these things like specifically the way we're talking about them, but extrapolating this over onto, okay, now I don't think short stocks are going to make money, or I think maybe it's okay to take it further and limit shorts further. I think that you can go too far, and you don't want to do that. So, so I think another thing too is one of the tenets of classic trend following, in my opinion, obviously in my opinion, and I don't expect anybody else to agree necessarily, and that is, do not separate your trade stats based upon longs and shorts. There's no such thing as short expectation, long expectation. It's the combination of both. Well, I'm kind of doing that, right? And so the stock expectation with longs and shorts added in is pretty darn good, but you shouldn't look at short expectation of stocks versus longs like you shouldn't do it for any market. You shouldn't look at the expectation of corn versus Swiss, grains versus currencies. It's add everything together. There's all the longs and shorts, all the different markets, the markets that have never made money, cocoa, and there's your trade stats. And so you shouldn't even be doing this exercise. And so I think that's the lesson: is do not pay too much attention to this back test that has told you 60-40. And I was thinking today that is it, I don't, to some degree, I don't think trend followers are that comfortable. I'm not that comfortable like relying upon what stocks have done historically, because it's not a back test. It's not a back test with 5,000 trades. And so I am uncomfortable agreeing that there is this equity risk premium. Now, I'm not going to make a big deal about it and argue, because I'm out of my league arguing about it, but it doesn't fit with what I know to be robust. And I'd much rather trade the single stocks, those 500 stocks, long only or long short with trend following. And even if it has inferior performance, versus relying upon anything buy and hold, which is just a happenstance of history, that the history may not look the same in the future. The chances of my trade stats looking the same in the future, much, much higher, my opinion, much, much higher. The trade stats, right. The buy and hold equities and bonds and 60-40, I never believed in it. So I'm ready. I'm ready. And the only thing I'm too conservative to approach the day and approach my portfolio without a price-based entry, trailing stop, and stop loss on every single position.
Jerry, can I? Hi,
Yeah.
how are you? Sorry, absolutely. Can I ask you a question? Is it the same for trade stats and for parameters? Meaning, you say, okay, you shouldn't separate trade stats for shorts and longs. Would you do the same for the system parameters or not?
I use the same parameters on all the markets.
Okay.
And at one point when we were getting into stocks, we were getting into trend following stocks at a period where, well, I was going to say stocks were doing incredibly well, but they've been doing well since August of '82. That's when the stocks and the bonds kind of got out of their funk, and they haven't kind of looked back very much. And so, yeah, so most of my career, the stocks have been pretty darn good. And so we would, when we started adding in stocks and deciding what parameters to use, the stocks were overwhelming the performance. They were doing so much better than the futures, let's say, uptrends, no down, no short trades really. And they were making so much money that if the stock back test said, hey, become even longer term, then we would say, oh, since we're committed to trading everything with the same system, the stocks are telling us to be longer term with the futures market. So we have to be very careful about how much to weight the equities. They're dominating. They're dominating this back test, and so we were like, yeah, let's don't let the equities dominate so much, because yeah, I don't know if that was right, but that was one of our thinking. So absolutely, we trade all the markets the same, longs and shorts the same, except for the entry filter on the shorts. And yeah, we've never optimized the sectors or the markets. And so, yeah, that's a given.
Hey, Jerry. So yeah, I just wanted to remind us, everybody, of this little caveat that we discussed even before, which is connected to the same discussion, connected with the short example and connected with 60-40 stop going up. So this is the thing. With everything going up, basically, okay, so the classical trend following with the fixed size at entry and not keeping it inherently only allows infinite potential, infinite outliers on the longs, whereas on the shorts is by default, by logic, limited by zero. So every short trade that you enter with classical trend following has a maximum ATR profit. It could be huge, it could be big enough for you to enter the short, but it's not infinite. Only the longs have infinite, whereas the shorts are inherently clipped at 30 ATR, 40, 200, 300 ATR, whatever the difference is between, whatever is price divided by ATR at point of entry, That's how many ATRs you have, and that's the clip. That's the clip of potential profits. So there's inherent asymmetry between longs and shorts that is inherent to classical trend following, because prices are the way they are and because zero is the absorbing barrier. So this actually imposes an inherent asymmetry, which I think biases classical trend following to perform or take advantage of outliers better with longs or in upward moving markets versus downward moving markets. And where this may show, and we've had this discussion before, I'm just wanted to conclude, because we're talking about the same subject. I just wanted to wrap the subject. This is not something new that I'm uncovering. We discussed this. So so basically, when or if the 60-40 starts now going into a bear market for the next 20 years, let's say, where shorts start making more money and versus longs, and where the unlimited upside in longs is being clipped because everything's kind of going down, basically. It's a long, slogging deflation. So then classical trend following, so the market will clip the upside on classical trend following because nothing is going up anymore. So the infinite upside of the outlier for the longs is being clipped by the markets. And then the classical trend following is exposed by the clipping on the shorts. It's being clipped by the shorts because the shorts can only go to zero and not much more than that. So if and when the world becomes deflationary and prices become going overwhelmingly down versus up, I think this will clip the outlier potential and the profit-making potential of classical trend following. And so even though there will be nice and profound downward trends everywhere where you should be making a lot of money, and a lot of trend followers will be making money, I think that's when the dynamic position sizing and the vol adjusters will be making huge amount. They will having 40-50% up years, where a classical trend follower, whether it's because of its filtering the trade or not entering, or because it's not adjusting size, it's not having outliers. Basically, you're not having outliers. The average win will be closer to the average loss. The statistics will change because the outliers that are mostly now coming from the long side will disappear.
Now I was agreeing with you a lot on that, but then I don't agree with that the filtering of the shorts that one would do would worsen performance, because look, when you clip
No, I agree. Let's skip that.
okay, okay, well, I just wanted to make a point that when you essentially when you have a filter like this, and we have, to some degree, like the entry breakout is a filter, right? It's filtering out, as Richard would say, it's putting us in this rare territory of where we're only going to be playing ball with where the potential is the greatest. The 200-day high is kind of a massive filter, and so so when you have breakouts or when you have the short filter, you do the back test and it says, okay, you're still going to have your same risk budget, if not a little bit higher, because your system is better. And then you're going to take that exposure that you would have had in those bad shorts and transfer it to all the other markets. So you're going to be trading the better trades bigger. So, okay. Now, I think that one thing I wanted to say is that, okay, we're obsessed with doing the same thing all the time, and we're obsessed with treating all the markets the same way. So yes, I guess there is some problems. There could be some downside to that. So we're not going to. I'm already cheating. I'm already need absolution from for treating these shorts differently. And so that's it, though. I'm not going any further than that. That's probably not that great of an idea, but I'm willing to do it, and but nothing else. So we're obsessed with treating all the markets the same way. We're not going to ever agree that in order to get out of this potential bind that you bring up, we're going to do even more non-systematic discipline and treat the markets with this with this vol management. We're not going to do that. Okay. Now, I think one of the things that you assume, which I don't think we assume, is that you're not going to have outliers. And so we keep mentioning and saying that when all the markets move like the bonds did or the dollar did like last year, the bond markets, the managed futures CTAs, that's where they really make their money, because it's this big sector move, and they're trying to get rid of the outlier trades by scaling them back, and they want the best short yen and pound to look more like the euro that's not going down as much. So because the pound and the yen are getting too volatile, so they're going to scale those things back, and they want all the positions in that sector to look more similar to each other with the same vol and current risk. So we don't play that game. So we are saying, our game is, we expect during sector moves or no sector moves that bean oil is going to make 100 ATR. And it may be the only grain that moves. And it may be one that moves much more than all the rest. So that's our game plan, is when deflation comes, or there's all these reasons that the whole group we're in this deflationary period or whatever. And anything you describe, you can make up any scenario. I'll agree that it's definitely possible. I have no trouble with that. We've never seen it before. It can definitely happen. So, but I think that you're over. There's no way to know that we won't have this 10% of our trades, that I won't have 30 outliers in this vastly different group of markets and stocks, that there won't be 10% of my trades won't have this outlier move, given a period of time when there is disinflation and shorts are really doing well. So we may still get those. You just don't know. But granted, I like to make money when the sectors move, but my system is not set up to do that. And I think managed futures CTAs could have trouble with in periods where you're relying upon these sector moves and you're just not getting them. And then can you just imagine, though, also that part of what I hear when you say this is we're continuing to increase these positions as the vol goes lower and lower. And vol always doesn't go lower on short trades. We've had this disagreement or discussion recently because I'm always out there hunting for these short stocks to put on, and I'm scouring 1,000 different stocks with my screener trying to find stocks to put on. And happens usually is that as it approaches the downside breakout and I'm ready to add it to my portfolio of shorts, the vol kicks up. And then I can't do it because the vol, the ATR filter is not satisfied.
Yeah, Jerry. So, yeah, the sector moves, I think that's a different subject. I think that's not relevant to what I was trying to say. But what I was trying to say is, in a world in which all markets, commodities, all your markets are 30 ATR away from zero, there's no way for you to get 100 ATR outlier. That's my point. So you're basically, if you scan your portfolio, if let's say everything starts going down slowly, some things more, some things less, but overwhelmingly, instead of going upwards over the last 40 years, over the next 40 years, overwhelmingly things are kind of going down slowly. Let's say just like a mirror universe in where the preponderance of money will be made on the short side. If that is the case, and you scan all your markets and say, hey, my markets are between 20 and 40 ATR away from zero, all of them. They're all between 20 or 40 bucks. They're all kind of $1 ATR, and they're all kind of between 20 and 40 ATR away from zero right now. And mostly I'm getting short signals. So you're basically, in this world in which most of the money is being made by shorts, the most you can make on a trade is between 20 and 40 ATR. Whereas in a world where everything was going up, you had trades with 100 ATRs, 200 ATRs, OJ holding for 4 years, 300 ATRs. Those things will disappear. And because those outliers are so huge and they affect your profit and loss statistics by so much, Without them, the win ratio, the win to loss ratio, and the percentage winning rates, it's going to be affected.
No, I mean, we just disagree. You're repeating yourself, and all I can do is repeat what I said. So, and then I say something about sectors, and you say it's beside the point. It's not what you were talking about. But then your next statement is all the sectors are going down. I mean, so it is about sectors. It is about all the sectors, or one sector, or it's about these macro moves. And all our disagreement. I'll repeat our disagreement again. Our disagreement is, I I don't think necessarily that I know that within these big sector disinflation and the whole portfolio or most of the sectors are in downtrends with these crappy shorts and shorts that don't even meet the filter. All I'm saying is I'm banking on that there will be some outlier trades in that particular period as well. I don't need, like managed futures CTAs, I don't look at things from a sector approach. I'm happy that I made a lot of money when every single one of my bond and interest rate futures went down over the past year or two. But I'm really make my money and stand out when the outliers happen, and an outlier can happen, not just OJ that has nothing that's correlated with it, or not just um, Cocoa that has nothing else correlated with it really, but within a down move in currencies, maybe we'll have one currency or a couple of currencies really crush it and kill it on the opposite direction. So that's where we disagree, is that I don't think that regardless of what happens in the disinflation and what happens to all the sectors in general, that precludes we can have massive uptrends in 10% of the trades.
I guess this scenario where everything is only 30 ATR away from zero is pretty dramatic. If things happen just as you were describing, absolute, that everything goes slowly down to zero, the ATR will be minimal, and everything will be much farther away from zero in terms of ATR than 30, I suspect. But anyway, another point you brought was that this discussion might be too philosophical and not very practical. But I guess these discussions are the most valuable, and this is the place where we can have them. So I thank you for that. Okay. Now what we observe is that the trade stats show better long trades than short trades on the history we have observed. And this may be a feature of the models themselves, or maybe a feature of the markets. If as we have observed a great inflation of asset prices in the preceding years, it might be the case that the longs have performed well because the markets have been behaved so. And perhaps going forward, our models our systems can profit from an environment where shorts are more are stronger. So the question turns if the models themselves cannot cope with the shorts. So I suspect it wouldn't be that much of a problem, and I propose a test for this. Take the prices and apply some monotonic transformation on that. You may apply a log function on all the prices and pretend as if you were able to trade the log prices. The benefit of that is that the zero is no longer a lower bound there, because everything you apply log to, as it gets closer and closer to zero, actually it will go negative and will not have that lower bound. Now, one feature of the breakout models is that they have a mathematical elegance to them that the maximum will be a maximum after any transformation you apply to the price. So the same thing applies to the minimum. So I suspect that if we test these systems on these artificial log prices, the results will be closely the same. I don't think that. So to sum it up, to wrap it up, I don't think it's a problem of the systems themselves. I think it's a feature of the markets we have observed, and it's just a result of a incomplete history that we have on our backtests. It just reinforces the the humility we have to come with these results, and the suspicion we should evaluate any backtest result.
Yeah, Bruno, I've done that test, and the result will be if you have predominantly falling markets and not markets going up, the only way to make the money on the downside with the logarithmic price is with dynamic position sizing. If you keep your size fixed, especially on a longer term system. But by the way, if you have a short term system like Alp, whatever, you're adjusting to ATR almost daily or weekly, so that's not a problem. But in systems that hold positions for 1, 2, 3 years, long-term systems, then it becomes increasingly important whether you adjust size or not. And on the downside, if you keep your size from 3 years ago, on the downside, your profits will diminish and diminish more, especially even on the logarithm, be indistinguishable from zero. Whereas the downside, that when it goes against you, the downside, the risk will be much bigger. So the only way for you to trade the logarithmic chart is if you adjust position dynamically, and that's when your P&L will actually match the form of the logarithmic chart.
There's another issue. I don't know if I'm thinking correctly about against putting the rule of going of capping things in zero, and that would be, for example, the few trades that were below zero, like WTI, electric futures, etc. You wouldn't get those. I mean, I know there are very few of them, but they happen, and it could happen in the future, right?
I think those are non-arguments, especially with the crude oil. I mean, if the fact that 0.001% of the time some price can go for negative for like few days and then come back viciously, it does not. It's just an exception that just proves the rule. I mean, the whole world can go negative and go back to negative infinity, right? Like it can go to positive infinity. It can go to positive infinity very easily philosophically, but going to negative infinity, it will never go. So to be able for you to claim that you can get equal outliers on the negative side to negative infinity, just like you can go to positive infinity, I think it's unfair. We all know it cannot happen.
Yeah, I was thinking about that when we saw that Austrian bond, and I tried to get the rationale of who was buying those, and I thought, I don't know, maybe somebody who thinks that negative interest rates can go on for forever, because if not, it doesn't make sense to buy something like that. But you're right, meaning that it's very there are very few, even in the front month and with so few days to expiration, it will be a very strange situation to trade that. But I don't know, maybe it was an argument. And by the way, if that Austrian bond was weird, imagine that at one time there was an Argentinian 100 years bond. So if you wanna manage risk on that one, that's an interesting one.
And why didn't those governments just even lend more? I guess at some point people have to do what they have to do for other reasons, and then you're getting negative rates, and you're afraid that they may go more negative. But yeah, it doesn't make a lot of sense. But I bet the government wishes they had issued even more of those things.
Oh, Jerry, yeah, there's a lot of regulations. Like even if in countries, not necessarily banana republics or whatever, there's like for pension funds, there's like requirement that you have to put 30% of your portfolio in local government bonds, like stuff like that. So in the pension funds, and then there's also regulations in the banking sector, not from governments but from central banks, even in America or even even in developed countries like not banana republics, where if you do not have a certain percentage in government bonds or in stocks which are considered risk-free, let's say treasuries, and I'm sure the Austrian bonds are considered risk-free in Austria. If you don't have a certain allocation, you can be sued for abrogating your fiduciary duty to your investors because you don't have them, you don't keep your portfolio in so-called safe assets. So there's a lot of regulation and limitation that huge trillions and trillions of dollars are being managed under. This industry is not even close to being free. Whereas like a thinking individual can say, listen, this doesn't make sense. I'm not buying a 100-year Austrian bond with negative 1% yield. This is stupid. And nobody can even say that in the meetings. He'll be fired. So there's a lot of stuff like this.
I think they raised 16 billion with that bond.
Congratulations to the bankers who sold these bonds.
Oh, and then the same regulators are criticizing Bitcoin because it has a drawdown of 60-70%. This bond is 98% down, and it's not a shitcoin.
I'm just reading another tweet stream we had, I think last week or before, where I posted this article called where he talked about the impossible triangle, the combination. It's the combination of diversification, stable positive return, and crisis alpha. Can it be achieved? All three of those. And I said, well, why don't we just move off of that? Why don't we just get away from crisis alpha and just try to achieve stable positive returns? And, it's kind of like the first step for everyone has to be, okay, you're definitely going to have this long piece, equity, maybe equity and bond, definitely equity. Now, how are you going to improve it? I mean, it's just a done deal. It is this marketing thing that, people were talking about this morning on Twitter about it's a marketing thing. Other people were saying, yeah, it's just this machine that raises money. And I was thinking, like, how absurd it is. Can you imagine an investor in Medallion, that makes 50% a year or whatever, approaching it like this, saying, I don't want too much Medallion because obviously I have my long bonds and long stocks. And so maybe how much of Medallion should I add to my long equities? This is absurd. And so everyone goes along, and the trend followers with all the different markets, the stocks that they could trade, long and shorts, hundreds of markets they could trade, they would try to say, hey, let's try to offer people not equities plus something, just the plus something. It'll have equities. I'll say one thing. Trend followers, managed futures will never step in the breach of 60-40 and be what people need it to be to replace the 40 or the 60 until they trade equities for their managed futures clients, because they, some reason, refuse to do that. You cannot even talk about it. They trade. Campbell trades 5,000 equities. He mentioned it again on a podcast last week, the RCM podcast. They trade 5,000, not for managed futures people, not with the trend follower. Cannot do it. And it's absurd. This is where we need to be. If you got people in the one sector that could come to the rescue, that could provide this scaled down version, the poor man's version of Medallion or multi-strats or whatever. Okay, we're not ever going to be as good as Medallion. We're not ever going to be as good as multi-strat. But we can offer so much diversification, so much safety without any compromise to the upside. The one group that could possibly offer this has no interest in it.
There's your chance, Jerry.
That's right. I mean, I already said, like,
Please.
I complain about it. I make fun of it. I ridicule. I mock. But it's kind of like a business decision. It's a great business opportunity. I mean, back in the day, when I first started trading, I was had a client who was kind of a multi-advisor CPA organization at a big brokerage firm, and they gave me my first money to manage, and they had lots of clients and lots of different traders. And these guys were super smart and very sophisticated, and they would invite me to dinners and stuff with other managers that they were interviewing and or whatever at conferences or whatever they'd say. And some of these managers would really try to give me the business. Like I know one of them, who, he didn't last very long, of course. He just looked at me and said, "I'm on the other side of all of your trades." I'm like, oh, "Okay, I don't even know what you're talking about." Well, whatever. And but anyways, I would used to ask whenever they would tell me about a new trader that they were looking at. I would say, "Is this guy a trend follower?" They'd say no, and I'd say, "Oh, thank God, fantastic! That's great." So because I didn't, I was pretty confident, and I didn't really need more competition, and for those assets or just in general. And so now, like kind of like at the same time that I complain about all this stuff, I also would be very nervous if someone said, "Oh yeah, we all agree with Jerry. We're going to trade single stocks and go short, and we're going to do just what he's been telling us we should be doing." I'll just be, "Oh God, stop! What did I do? I don't want that. I want you guys to keep doing it so I can keep complaining."
Hey, Jerry. Good morning. Thank you for the spaces once again. And I just want to weigh in as a small retail investor leaving the big trades, the big guys. I've got most of my money with Jerry through the mutual fund. And we've got Dunn and Lowcore and Pimco in lesser positions. We've got Eric and some of the others. I think Jerry pointed out there's a man ETF that's holding like 10 to 20 positions, and they think that that's something. Maybe you'll talk about that in a moment. I'm doing 6,100 and something single stocks that I data sweep every night, courtesy of CSI Data for $300 a year. I look for. I have a long-only, long-term retail fractional dollar minimum dollar only Robinhood account that I've got about 600 positions in. So it's about, what is that, 10%? I've got one program, 200-day in, 150-day out, and my stop loss is now at a 6 ATR, which I'm very comfortable with. Talked back from the ledge thanks to Jerry and others from 3 or 4 or 5. I look at those each night as well, the 3, 4, and 5s. So I've got a 6 ATR. It's a 14-day average. And, it took a beating this past week, but it's still positive. And those 600 positions, maybe a little more than half this past week because of the beating. But each of those positions, the greens are at like 22% plus, whereas the maybe 45.5% of the portfolio is at like 8 minus. So things running at like a 2.6x. And that's trend following, baby. I just love it. Love it. Thanks, Jerry.
Yeah, you gotta love it. Somebody just pointed out that I titled this space's trend following trading ideologues dangerous cult meeting. Yeah, that's what someone called me the other day. Trend followers are a dangerous cult. Yeah, maybe. It's no
Dangerous for who?
that's right. I have
60-40.
to. Yeah, 60-40. Non, discretionary.
The predictive types.
Discretionary. Everyone wants to add discretion, but I will say that I am frequently reminded of, being too smart. Having these degrees and being incredibly smart is really limits, and it really changes what you can accomplish in life. And I think that it's rare. The other Moritz, he is like got these degrees and PhD in math and computers, and he was able to not allow that to stop him from understanding how he needed to properly trade and think about the markets and incorporate more trend following, make trend
It's
following
not
number
just him,
one.
Jerry. If you notice,
Yeah,
Wayne Himmelson as well, over the course
yeah,
of time, has come our way with his process. So I think as experience builds with these people that are heavily into the statistics and the nature of it, they ultimately come to the conclusion we have.
right.
Oh, I'm
And
I'm an I'm an ex PhD myself.
can you ever be an ex PhD?
That's the joke.
Sorry, sorry, I'm off. Our number one rule here is jokes are much more important than any sort of trading insight.
No, actually,
Uh,
no. I do have a PhD. I have an engineering PhD. So, and also
no, I know.
with programming and math and everything. So,
Right, right. No, that's what I'm saying. But
And jokes are funnier when they're explained. So there's that.
um, yeah, so I think that I just realize when I engage with people so often that my path to how I got to where I am is the reason that I am able to stick with what I do and not have it sort of messed up by too much other influences. Uh, Try to find something
I'm
else. Go ahead.
jealous. I'm jealous, and I envy people who had mentors, good mentors early in their lives and in their careers, compared to as opposed to people who had to slug it out on their own and learn everything on their own.
But absolute, as you
I wish
said,
I'd seen that ad in the Wall Street Journal.
sorry, absolute, as you said on last week, you have to be intelligent to follow an intelligent person. So that's very important. You have to know how to select.
Yes, I mean, yeah, that's true. But then also, that's a matter of selection. But then also, it's a right time, right place, who you end up being next to you, and how who ends up being around you, and whatever. I'm not saying one way is better than the other, but I do I know how important I myself am now a mentor to few people, and I can see how much easier it is for them to not have to go through the things and learn the things on their own. Like if you have a mentor who know what they're doing, it's tremendous. So yeah, I I had people, smart people around me, but I never really had a mentor to kind of guide me early on. So that's what I'm saying.
Yeah, I've never heard anybody in trend following who I thought was knew as much as my mentors, and but they achieved a lot because one of the things is that I should have had more mentors. I should have said, "This was a great 4 years. Let's go do this again. I haven't learned everything that I need. Let's go leave Chicago, go to New York, and learn all you can about adding single stocks to the trend following, and keep this thing going." But I didn't do that, and then what happens is a lot of the big CTA firms, they have surrounded themselves, the founders, with more and more smart people who are helping them. So uh, surrounding yourself with incredibly intelligent people to help you get deeper and deeper into proper trading and trend following is very important. And so I kind of dropped the ball. I mean, I had some very smart people around me helping me, but not enough. And then I think to some degree you can overwhelm those people where you got to create an environment of that where their ideas are welcome and they can make make everything better. And so um, that's that's how you can overcome not having a great mentor is just hiring people that surrounding yourself with people who are really talented and see things from a different point of view. And I was doing that, but not enough. And then my role became in these meetings, these research ideas was to limit basically the optimization, and try to push back on the optimization and not allow too much of that to occur. And it was really, with the few people I did have, they were really talented, and we did make a lot of progress. But yeah, I should have a mentor today, maybe older or younger or whatever, but you should always have someone you can, and I guess maybe this spaces and interaction with all of you guys serves that purpose to some degree. I've definitely learned a lot from the people in these spaces.
Unfortunately, most of us are sort of getting to the end of our trading careers at this point in time. I was doing a presentation down in Adelaide, and I was presenting the trend following way to them down there. And at the end of the topic, one of them got up and said, "Yeah, we appreciate where you're coming from, but we're all 60 here, and how can we make money quickly?"
That's right. And the person that you're learning from doesn't have to be kind of like right on everything. They could just be right on some things, and you got to filter people. You got to filter, things you hear and learn into your worldview that increases, and that doesn't. If it contradicts with something you believe, you've got to really spend some time to figure out which way you're going to go. Keep listening and learning, and I'm worried too that that I keep a lot of notes, and I kind of have written a book, in the sense that I've written down all my thoughts over time, and so I need so I've told my wife the password. So what I'm getting at is I don't want things to be lost. I mean, what a shame if turtle trading and all that we've learned on these spaces and we've said and written and done kind of is lost. And I think it's probably going to be, honestly. I think the tide is too strong. The classic is not going to last because it's just too hard. And the other way of doing things is too popular. We're swimming upstream and we're going to lose the battle, we're not going to be in the majority, and then our ideas are going to be lost, and how we protested and stood up and pointed out because they're ignored. On the podcast, we'll have a great podcast. Richard will go on a podcast, lay the law down, and then no comments, nothing except, okay, that sounds good to me. And then the next podcast will be a total contradiction of what Richard just said. And it happens all the time, over and over. And so there's no carry forward. Not enough for me.
You've got to get that all down, Jerry, and put a title on the book, Reminiscence of a Trend Follower. So in 300 years' time, it can really be appreciated.
Reminiscences of a Trend Operator.
And I think that our idea is so great that at least it's much better than something than S&P, for example, that people like. So we have all chances to be very popular in the future, I think. I believe in that.
Jerry, is funny because I had the opposite concern sometimes, when, for example, AQR started raising lots and lots of money, or Winton started raising lots of money. I start to get worried about that. And you have just the opposite worry, which I think it's funny since we share a lot of philosophy, etc., and then we go to sleep with different concerns.
I'm actually not worried. I mean, the more I learn about the world, the more I realize that the mainstream is usually at least the best lukewarm, if not worse or bad, on pretty much any subject. And if my opinions start verging towards the majority, I start to get worried, almost as a defense mechanism. It's like, what is wrong with me? Why do I agree with like 80% of the people on this subject? I probably haven't studied it enough. I have to dig deep. So I go dig deep, and when I slowly put myself on the outskirts, like in the 5%, 3%, 10% of opinion, that's where I feel the most comfortable. And it's the same with trading and trend following, systematic trading. I think the gold is found in the outliers, in the outskirts. Like nobody wants to be in the middle of the distribution. Why would you shoot to be popular? I think that dissolves and kind of dissolves the quality. I think the average is never something to shoot for, and the average is the majority. You're average when you're most popular and most people like you. So I think that's something that you need. Just like we're hunting outliers in trading, we should be hunting outliers in philosophies and in opinions. That's where the gold is.
Yeah, but you saw that Austrian bond, for example. I mean, there's a lot of committees making decisions these days. I mean, if you got all the pension funds that bought that bond and you ask every single one of the beneficiaries of that pension fund, hey, would you like to buy this bond? Everybody will say no. But there is this commission, these committees in the middle who make those strange and weird decisions. I guess they have to do with their own career risk that skew the results of everything, at least for some time. Then I guess it goes back to normal and outliers start to appear. But they are average by design. I mean, they take average decisions. I mean, for example, in Argentina, when the pension fund existed, there was a penalty if your returns were too different from the average. So, these kind of things exist, but I guess in the end they disappear, right?
Yeah, but that's the thing. We cannot expect to become the average, to become the majority or accepted wisdom, and then expect to extract money from the same average and wisdom. We our performance is the way it is because we are on the outliers, and then there's a huge average that doesn't know the things that we do. So any return that we make on top of the 5% of productivity growth on planet Earth has to be taken from somewhere. And that quantity of averageness and mediocrity has to be big enough so that we can extract our profits from them. So I'm very comfortable when we're in the minority. That's a perfectly balanced place to be.
I agree. Who's another? Oh, I wanted to get the smart guy's opinion on this one tweet I had earlier this week, October 2nd. Oh yeah, all-time highs. Is all-time highs breakout? Is that a valid parameter? I'm not picking on who. I don't want to pick on Felix Augustus. No, but I just thank you for bringing this up. But and I write most any breakout is a better entry signal than all-time highs. There's no reason to wait for all-time highs to enter a trade. Oh yeah, all-time highs may be the 500-day high. It may be the 100-day high. So and I think that's where. And so why are you waiting to the all-time high? And then I guess in my mind I can't really pinpoint the reason. I just think all-time high is not a real parameter. Like I said, if you're going to buy the 100-day high, you do it every single time, and you do it, and the computer rewards you for that, because you're 100% consistent. And if you're going to buy the 300-day high, then go ahead and do it. All-time high can be anything, and and then what about the sample size? I don't know. All-time high is not a robust parameter because it's really not a parameter. So is that true? I mean, I don't really like all-time high. I will say one thing. I don't think we've ever tested it, but we can. And I will bet, I don't know how much money, but a dinner or a bottle of wine on that all-time high. If you compare it to the typical longer term breakout, that it will dramatically underperform. And you use the trailing stop and the stop loss are the same. The markets are the same. Everything's the same except all-time high versus a numbered parameter. What do you think, Richard?
Yeah, I think go for the breakout, Jerry. All-time high. That's a moving target. I prefer sort of the principle of breakouts from congestion, all of that sort of stuff. So there's lots of ways to catch the breakout. So I think the Donkian is a very good method to make sure we're medium to long term. that's not necessarily going for the all-time high. It's interesting, actually, with the Donchian. The Donchian high can get lower in a bull market over certain sort of congestion periods. It's a pretty unusual little indicator when you look at, say the 70 period look back. When the 70 period look back is over, it's not necessarily we're going to get a new high. We might get a lower high. I tend to, with my rules-based processes and the indicators I use, I tend to go off them rather than my assumptions about, where the all-time high is.
Yeah, Jerry, all-time high is just the limit version of the Donchian. So all-time high is a Donchian with infinite lookback. So just like you have a donk 100 day, 200, 300,000, 2,000, 3,000, 5,000, 6,000 day lookback. So you start running these tests with different lookbacks, and as you approach infinity, the performance of all-time high trading system will start to approach the performance of the system as you increase the lookback of a Donchian. So, so maybe all-time high performance will be the performance of a 3,000 day Donchian or something like that, or 5,000.
But could it be that the follow through on the all time highs is better than, say, like a 100 day high? Because if somebody's got the conviction to buy the all time high, I'm assuming there's whoever's buying is really predicting that the company going forward is going to continue to grow, or that there's a lot of growth going forward. I don't know. I just saw this research. It went back from like 1985. They back tested it. I think it was for just the S&P 500 stocks. The strategy was to just buy the all-time high and do like a trailing stop based on like the ATR. And they did it from like I think the mid 1980s or 1990 to like 2012 or so. And I think the returns were ended up being like 16% a year. I actually sent it to you, Jerry, on your messenger. It was a video explaining the research.
Yeah, there's nothing with stocks. Yes, there's nothing wrong with stocks, but it's every backtest that you do on stocks over the last 50 years, all-time high will be indistinguishable from a 1, 2, or 3 year high if a stock is going higher. But if we get a 20-year bear market where all the prices become, all stocks go down, you're not going to have a single trade in that backtest because all the prices are going to be under the all-time high, or it's going to take 10 or 20 years for that high to be reached. Like Japan. Okay, start trading all-time highs in Japan where it peaked in the 85. So run some backtests there and see how it performs.
So in a market like that, you're saying just lower the look back, right?
Well, that's what I'm saying is all-time high is just like breakout with infinite lookback. That's
Right,
all.
right. So let's say
now,
I'm sorry, go ahead.
So yeah, if you have no trades with infinite lookback, lower your lookback to get some trades and see what statistics you get.
I just think that if you use a consistent breakout or moving average crossover, you're going to have better back test. That's all. And then I'm not a fan of, or you should explain when I tell you I'm not a fan of something before you tell me what you meant. But I'm not like a fan of bigger follow through, quote unquote, because I don't really think that information is available and relevant to following your system. And I don't think there's more information to be. There's no enhancement to a trend following system to be had by trying to look at it in terms of which parameter or entry idea gives me better follow through. It's because probably my best trades, I bought the high of the day of the month and it languished with no follow through. And then after everyone got tired of it and the breakout didn't immediately go somewhere because somehow someone has told them that that's what trends do. They're good ones. They immediately are profitable. it took off and made a ton of money. So I don't think there is information in the trend following world or systems that you can pick up about follow through or relative strength or like a signal that says, aha, this particular trend is not worth me waiting until the stop loss to get out, or it's so good because of this extraneous factor beyond the 100-day high, for instance, that I should double up on it. And I don't think there's anything magical in all-time highs or breakouts or moving average crossovers that's going to signal any kind of reason to overweight that. The market's not. I don't think that's a good idea. It's nothing. There's nothing to these markets from a trend following point of view. There's no information. The trade is great until it gets really, really close to that, or until your trailing stop or stop loss gets hit. Yeah, I mean, and it was hammered in my head in 1983. I was reading this guy who writes for the Wall Street Journal, who I really like him, Swag. He's really famous. I forget his first name, but he was complaining today in a tweet that he never gets a lot of comments on what he thinks is the good stuff he writes versus kind of like the mediocre stuff he writes. And so I'm the same way. I just gave you guys a lot of great heartfelt inspiration there. And some of my tweets, man, some of the best ones get like one like. Sometimes I'm tempted when I see a crappy tweet from someone else to say,
surely that's me, Jerry, isn't it?
That's right. Sometimes when I see a crappy tweet, I'm like, that's really kind of like disagrees with me. Let's just be honest, right? And I'll say to myself, I should like tell this dude who tweeted that, hey, dude, you got 0 likes, or like 1 like. But then I look at some of mine and I'm like, oh yeah, I have 1 like as well. So I wonder if Elon's going to get rid of likes. You know what I wish we had is I don't like it. So you wouldn't have to feel compelled to write something.
We'd be cooked, Jerry. We'd be cooked.
But I think it would be back to, I agree with Absolute 100%. We would be reveling we would be bragging to each other. I have more dislikes than you have. I tweeted something we all agree is true, and I had 1,000 dislikes, and because we want to be in the minority. And I agree, we do. That was another thing that I was taught. It's a lonely job. Don't desire for people to like your positions and agree with your positions. And when they do, you should get very nervous. I was telling my wife, she thought I was giving her this explanation the other day, and I launched into endogenous and exogenous. Now, I'm not even qualified really to talk about it, and so I'm trying to explain to her endogenous, exogenous. And I said, Richard told me about this, and this guy wrote a paper. I can't think of his name. 90% of the trends are endogenous, and this really fits in well with the long-term trend following. And so, oh yeah. And then I said to her, it was very similar to turtle training, where, at least in my opinion, I think it's somewhat similar, where Rich would say, trade these systems, follow these rules. However, if you want to spice it up a bit, and they called it contrary opinion. And so you should, when the trade first breaks out and you first put it on, you kind of want the fundamentals to be opposite the trade. You never want this confirmation. For math reasons, you don't want it. And then for, world reasons, you don't want it. The way the world is operates, you don't want it. You don't want people to agree with it. And then as the trade goes on, more and more people are going to agree with the trend until the very last person gets in. And he was like, if you read something in the paper that is bullish your trade, then you should be a little nervous and maybe you want to get out quicker. But if it's the New York Times, less so. If it's the local paper in your little small town, more so. And then if you get into the taxi, there's no Uber, if you get into the taxi and the taxi driver says, how about those soybeans? You should be very nervous. Like, tell them to stop, go to a payphone, liquidate your soybeans. And so I think to some degree, The exogenous is like the exogenous trend is something that is like the news is out, all the markets react very quickly, and then it's probably not going to be a long-term trend. Endogenous, it's internal to the market, not known by many. The fundamentals come out very slow, and so I think to some degree, Rich even picked up on in his way, looking at it that way. And of course, that I don't even know if that's in Covell's books. That contrary opinion, it's never talked about, but that was a very big part of the turtle. It was at least it was the part that they wanted us to incorporate and be more be less a bit less systematic. But then once we all got left, and once we all hired our computer programmers and our research, and we tried to be big shot CTAs, of course, we dropped those ideas as well. Alp, you want to tell us about your currency trading and short-term daily hourly bars? How's it been going?
Wow. Okay. So just to let you know, it's 5 minute bars, not hourly bars. Hourly bars was last year. Um, so my database is filled up with 5 minute bars, and what happens is when you're using this daily bars, two things are happening. First, it is filtering the data. So you're filtering so much data, and of course, when you open up daily bars into 5 minute bars or 1 minute bars, you're trading from an unfiltered data. Okay, and the idea is to be able to trade single digit breakouts. All right, so it's from you're gonna trade one day breakouts, and you heard me right, 1 day breakouts, then 2 day breakouts, then 3 day breakouts, up to 9 day breakouts, and this is your base system. All right, and high frequency trading is anything else that trades the single day breakouts on the lowest spectrum of high frequency to the millisecond by millisecond bars, or tick by. They said tick by tick, but those tick by tick data comes in millisecond by millisecond. So anything else between your milliseconds data to your single day single day breakouts is what the short term trading is all about. And so we're talking about speeds and really how fast you can go. Well, you can go as fast as you can go considering your costs, and that's where the art comes from. The science and the artistic science of short term trend trading. So that's why trend trading is forever, but trend traders come and go. Okay, so Jerry Parker really, on one hand, really taught someone else sometimes that he hasn't done his inner work necessarily enough. He's worried about the trend trading is gonna end. No, Jerry Parker is gonna end, but not trend trading. I am gonna end someday. I'm gonna die, but not trend trading. Hatha yoga is around for hundreds of years, right? And there are all sorts of new forms of yoga, like Vinyasa yoga, Ashtanga yoga, X yoga, Y yoga is around. Yoga is a very ancient practice. It's around, like martial arts. There's Chinese martial arts, Japanese martial arts, the Brazilian martial arts, the Taekwondo. So when you look into these, performance arts and sports, you see that these things have been around for hundreds of years, or maybe thousands of years. Okay, so Jerry Parker really needs to step up in his mental game when he actually reflects his inner self by talking. What is going to happen to trend following when I die? When I die, I can assure you that the trend following is going to survive. Not you, but trend following will. So that's why it's important to talk from that point of worthiness and that point of powerfulness rather than unworthiness and helplessness. It is very important to talk from powerfulness and from a meaning and from a perspective, from a belongingness point of view, where we all understand the fact that this is speculation as an art and science is the bigger school, but then trend following is a discipline within that speculative art and sciences. So you go to a university and you engineering, but electronics is one of those disciplines within the speculative art and sciences, and it will survive as long as speculation will survive, because there are lots of timeless elements within trend following. It's not possible to kill something else that is timeless. So so that's why I have a huge problem when Jerry Parker, Jerry Parker, who has hundreds and hundreds of $1 million, cannot grasp this basic idea. It really turns me off. It really turns me off. So that's what I wanted to talk about. I hope that he's going to say that trend following is forever. Trend traders come and go, but trend trading is forever. It's like,
Definitely,
I'm
I
not quite
agree.
sure what has.
I mean, I agree. It is forever. However, um, it is, our strategy, Richard, Moritz, me, you, Mulvaney, Melosinos, the one entry, one exit, stop loss, the trend following alone, trend following only, trend following plus nothing, none of the, just letting profits run and accepting volatility of open profits and killing losses very quickly. I think that is not very popular. And I don't think it is going to survive um, it's going to go through periods where it's complete, no one is doing it. It's not, it's going to
Well, make
be,
sure it's on your headstone, Jerry.
yeah. Oh, yeah, definitely. And then, because the people before us who did it, we hear about them, whether it's, I think there's a couple of people out there. There's one guy that I have on my website. I quote him as saying, let profits run, take small losses, cut losses short. David Ricardo. Yeah, so old people like that, they have these maybe a little bit of writings and a little bit of cliches that they put out there, and people remember that, ha ha. But look, the managed futures people, they read that and they just go, oh, that's really cute, that's really sweet. And then they have this soup approach where everything goes into the soup, whatever you want to do, vol management, correlation management, no stop losses. And I think, but then there will be one person or a couple people who do rise up. There will be five, maybe around the world, like the 5 or 6 of us. And then they will rise up and have a little spaces and talk about it and have a little bit of assets under management and have their little ETFs. And then I don't think that's going to change. I mean, it might change. It should, it could. Um, but it's always like, I posted in an article yesterday, and I'm not really into politics too much. I don't really like let it get to me and my beliefs and stuff. I don't really want to put too much emphasis into it and try to convert the world. I'm not really into converting the people into freedom, free speech, free markets, free men, free women, that sort of thing. But I do like to read articles and post them about, yeah, the world's going to hell because we don't have accountability or free markets and free speech. Like we should be more committed to these ideas. And it basically, this article was from The Economist saying, is like the free market over? And so I've lived, I mean, I don't think I'm that old, but I've been around and a lot and been interested in politics and following this. And I've seen these ebbs and flows of, socialism, capitalism, Carter, Reagan, and more or less, free market stuff and or the welfare state continuing to grow, government continuing to grow. And we kind of all know that, well, a lot of people kind of can agree that free markets is a good thing and it produces wealth, but we don't want 100% free markets. We need to have a safety net for some people, et cetera. And but I think it's the same thing, as the economy explodes, before Reagan, the Dow had never been over 1,050. And when it finally broke, when things got going in August of 82, it was just going crazy, 1,000, 2,000, 3,000, 4,000. And so we hit this period of tremendous prosperity, of lower taxes, and sort of, at least rhetorically, we were interested in less government and more markets. And so this produced a lot of wealth. It wasn't perfect because the people were falling behind, but it's almost like the wealthier you get, that's when it's going to kind of turn around. We can afford more spending, more government, more socialism. We can afford more of this. And we don't say to ourselves, oh, look at this benefits we've had and how the economy has exploded and wealth has been created. Let's do more of that. We got to cut rates more and rely upon free markets more. No, it's the opposite. We get wealthier and then we fall back. And this is the same thing with trend following. As this other trend following gets to be, as our strategy in the 80s and 90s became so successful, we didn't stick to it. No, Managed Futures said, what's next? We got to do something else. We've figured out the secret to markets, trend following, longs and shorts, lots of diversification. Now we've got that we'll always have. How are we going to make it better? Well, we're going to make it better by doing less of all of that. And so as that continues to recede and fail, it's a total fail, then our strategy of one entry, one exit, stop loss, which I just euphemistically say, if you have more than that, I don't really care, and it's fine. I have more than that too to my systems. That'll reemerge. Oh yeah, we over optimized, we overfitted. Let's go back. So they'll go back, and then as we have great performance, just selling that breakout, just buying that breakout, then that'll recede as well. And so I think that's the best we could ever hope for. But it's just so much easier to say, spend money on it. Just write them a check. COVID, give everybody money. And what could possibly happen? What could possibly happen? It doesn't look like there's any downside to zero rates. Let's just do it. And in the same way, the same thing would happen in our field and lots of other fields. It's just, why should we sit here with these drawdowns? This is ridiculous. Why are we doing this to ourselves? Add this. It's easy. And people like it. Oh, I get hit a lot of times. I get hit by talking bad about Sharp. And he was hitting me on this. You talk bad about Sharp, although clients love Sharp. Okay, I got to fit that into my back test somehow. I need a rule that overweights what clients like. Okay. Anybody else want to say anything else before we sign off?
I had no idea that Alp was so poetic.
I hope it's okay, Richard, if I mention to our friends here that we're going to, I'm going to go to Australia soon and hang out with my Australia friends. And so I wonder if we can do a Spaces while we're in Australia, Richard.
Why not? Fun. Let's do it.
I know. We need to do,
I'm looking forward to having you over here, Jerry.
Thank you. I'm looking forward to coming. And then also Twitter has this new thing that's called, I think it's called broadcasting. Have you guys seen that? Where it's up in this upper part of the screen and looks a little bit similar to a Spaces notification where you can just tap on it and you go to the Spaces. But this is like people talking, broadcasting, and I don't think you can include other people. I'm not sure how it all works, but we could just do we could do that too, where we don't allow anybody to speak. Oh, maybe we could pipe in Oleg from the backwoods somewhere.
Now you're making me laugh.
That'd be fun. But anyways, I did see where Elon got rid of when you post a link to an article, and then usually it used to be below it, the article would sort of pop up. You could see the headline and whatever, but I think he got rid of that as well. Not really happy with some of these trends, and I don't think Threads has taken off. But anyways, rambling here. Thanks for being here, everyone. We'll be back at it next Friday, same time. Enjoy your weekend. Enjoy the trading, and enjoy your trends. Thanks, everybody, for being here, and see you next week.